Welcome to Next in Tech, an S&P Global Market Intelligence podcast where the world of emerging tech lives. I'm your host, Eric Hanselman, Chief Analyst for Technology, Media, and Telecom at S&P Global Market Intelligence. And today, we're going to be discussing financial technology with returning guest Jordan McKee, Research Director for our Fintech practice. Jordan, welcome back to the podcast.
Hey, Eric. Thanks for having me back.
It's great to have you back. We've actually had a number of your team on talking about a whole range of different things in the fintech world, but there's been a lot of change and some new capabilities in the fintech practice. I wanted to actually kick off with just having to give us a little background into what's happening and what's been going on.
Yeah, absolutely. So it's kind of wild to say we're just over a year into the launch of our fintech practice here at S&P Global Market Intelligence. And a lot's happened in that year. So we've fully staffed up the team, boots on the ground coverage in North America, Europe, and Asia Pacific. So a nice global perspective of how the fintech market is coming together and the different dynamics across the regions. And really the team is charged with looking at fintech through a couple different lenses. One is sort of covering the market at a broad macro level, so tracking funding trends on a quarterly basis, M&A trends, secular trends across the different markets, and then simultaneously going deep into a variety of different fintech subsectors. So areas like payment processing, real-time payments, banking as a service, open banking, and in those subsectors, really covering those areas from the bottom up, going deep on the vendor landscape, on buyer needs, on specific trends that are influencing how those subsegments are evolving, and in some cases, consolidating. And layered over the top of that are a number of advancements on our quantitative capabilities. So we now conduct surveys of merchants on an annual basis, looking at their payment processing priorities, quarterly surveys of consumers assessing how they're adopting different types of fintech applications and the evolution of the relationships that they're having with financial institutions, an annual survey of small businesses and the way in which they're leveraging banking capabilities from the software platforms they're using to run their business. And most recently, a new market monitor product that is providing a global view of the payment processing landscape in terms of transaction volume, as well as revenue and additional segments to be added to that over time. So it's been a busy year, but an exciting year and lots of great advancements in terms of how we're covering the market, and certainly no shortage of activity going on to influence our coverage.
Well, yeah, no shortage at all. If we take a look at so much of the transformation that happened with fintech through the pandemic, now into recent times, with macroeconomic changes that are having a whole bunch of impacts in terms of what they're actually doing in the market with the various odds and ends of the place. And this happens to also be something that recently the fintech, I guess one of the major fintech events of the year, the Money 2020 conference had just come off, and a lot of things that were happening there. But you were out there at Money 2020.
We were indeed. Again, another kind of crazy thing to consider is my 10th year out at Money 2020. It's funny to think back. The first year I went, 2013, this idea of a payments and fintech conference was fairly novel at the time. Nobody was really doing events specific to fintech. It was sort of just a backwater of any, kind of banking centric show. And today, right, 12,000 attendees, it just completely unmatched in terms of the depth and the breadth of companies across the ecosystem that show up at this event. And it continues to deliver. I was out there along with my colleague, Michaela, and a couple folks from our consulting practice. And we held over 30 meetings, venture capitalists, financial institutions, fintech vendors, payment processors, enterprises, everybody in between was out there. Lots of great conversations. And maybe if I could rattle off a couple of takeaways I had just sort of circling the show floor and kind of stepping back from some of those conversations. Right off the bat, it was interesting being on the floor itself. 2 years prior, crypto was everywhere. Crypto had completely taken over Money 2020, every booth, every advertisement that you saw.
As it did in much of the tech world.
That's right. That's right. Those were heady times. And man, it came to life at Money 2020 in a big way a couple years ago. You fast forward to this year, crypto was pretty much non-existent. But what was still there was a focus on blockchain. It was interesting scanning through the list of sponsors, the biggest sponsors of the show, the 5-star sponsors, companies like Ripple, Stellar, Circle, Paxos. So still seeing those blockchain infrastructure companies front and center, pushing things like stable coins, central bank digital currencies, cross-border payments. So while that crypto hype has sort of died down and, we're in the midst of a crypto winter, maybe a crypto ice age, I'm not sure. The blockchain bit is still there, still very real, and still lots of excitement around how that can really add new types of efficiencies to different types of payment flows and banking flows. The other thing that stood out to me, Eric, again, kind of scanning through the list of sponsors, was the emphasis on big tech. This year, we saw AWS, Databricks, Google, NTT Data, NVIDIA, Salesforce, all as five-star sponsors of the show. Very, very big presence on the show floor. To me, it kind of spoke to the way in which not only is digital transformation, alive and well in financial services, but simultaneously, we're starting to see fintech evolve into a proper vertical for tech vendors to target. And as you might expect, generative AI was front and center in terms of themes being peddled by big tech companies. First day of the show, AWS and NVIDIA had an AI summit, and they were doing all sorts of interesting demos with their customers, fintechs like Ramp that are using artificial intelligence to streamline expense management. But I would say on that topic of Gen AI, I kind of walked into the show expecting to be blitzed in every single one of my meetings with vendors about how they were harnessing Gen AI and the way in which they're bringing it to life. Yeah, that was still there. It came up in most conversations, but it wasn't overwhelming, which was kind of encouraging.
Wow. Well, then that really seems to be the exception in a lot of the conversations that we're having. Interesting.
Interesting indeed. I mean, a lot of the conversations were about kind of the low-hanging fruit as it pertains to Gen AI and financial services. So, customer service use cases, fraud prevention use cases. But interestingly, a lot of those Gen AI conversations came back to the dark side of Gen AI and financial services. And what we've seen over the past few quarters are services emerging on the dark web like Fraud GPT, Worm GPT, that are being used by cyber criminals for the creation of malware for very targeted phishing scams. So it was interesting to sort of see the industry beginning to put a spotlight on how criminals are in early stages of weaponizing this technology against the industry. And as you'd expect, lots and lots of fraud prevention vendors, reg tech vendors at the show, we're talking about Gen AI in the context of the implications that it had for potentially leading to account takeovers, new account fraud, increases in payment card fraud, et cetera. So that dark side of Gen AI was probably more so the theme around that technology than perhaps the positive implications, which I thought was interesting.
Wow. So a bit of a cautionary stance in terms of where Gen AI is and what its impact is going to be.
That's exactly right. And a few other things that kind of resonated with me. One, open banking. This has been a prominent theme in a number of markets around the world, especially in Europe, in the UK to be specific, where we've seen regulators really guide the hands of financial institutions to open up their infrastructure with APIs to enable consumer permission data sharing with other financial institutions, with other fintechs. That hasn't so much been the case in the US, but 3 days before the show, the Consumer Financial Protection Bureau, the CFPB, proposed what they're calling an open banking rule that is very similar in some respects to what we've seen in other markets where they're looking to set sort of a line in the sand for when financial institutions in the US need to open up for data sharing with third parties. So as you'd expect, that was a prominent conversation at the show. More questions than answers at this point. Still some speculation on, if the rule will have enough teeth to actually be enforceable. How will liability be established? How will these data sharing frameworks that have already been put in place, like the financial data exchange, fit into this open banking rule? But interesting times in the world of data sharing as it relates to financial services. So, yeah, those are some of the things that stuck with me, Eric, as I reflect back on a couple wild nights in Vegas.
Well, it seems like the opening of financial data sharing both is an opportunity, but also starts to raise some of these questions about exactly as you're identifying where it gets used, who it's actually going to benefit, the extent of sharing that's going to be necessary, and as we've sort of hinted at before, what those risks are that are associated.
Yeah, that's right. I mean, there's plenty of great implications as it relates to financial data sharing as you think about onboarding into new accounts and the tedious process of opening a new account with a financial institution. Wouldn't it be great if you could just enter your banking credentials and all of your information, all of the KYC that's been done on you, all of your past transactions get ported over to this new provider. So there's a lot of potential in terms of supercharging competition in financial services and overall just elevating the experience that customers have and interfacing with financial products. But on the other side of the coin, there are concerns to be had as it relates to how will that data be protected as it moves in transit. And again, who's going to bear responsibility in the event of a breach or bad actors interfacing with that data as it moves from one provider to another. So still some question marks remaining in terms of how this all looks out in the wild.
It was something where, years back we had issues about access to credit reports and things of that nature and similar kinds of concerns that cropped up as that ecosystem evolved. But interesting to see where this happens to go. But that does open the question to what opportunities does it create? What kinds of things can any of these new providers that are out there take advantage of? Because they are now operating in a much more complex and I guess a bit more pressured financial environment when we think about what the macroeconomic impacts are for a lot of what's been going on. And this is suddenly at the point at which we've got interest rates that starts to sort of shift the game for a number of the players in this market. Yeah.
In a big way, it's interesting to see the impact that this has had on the fintech funding environment. So we do a quarterly analysis of data that's collected via S&P Global Market Intelligence as it relates to fintech funding. What we saw last year, globally, fintech funding dipped about $30 billion year over year. Through the first 9 months of this year, fintechs globally have raised somewhere in the ballpark of about 29 billion. Sounds like a large figure, but that compares to 54 billion through the first 9 months of last year. So you're seeing the interest rate environment come to life in a big way as it relates to the amount of funding that's pouring into the fintech ecosystem. It was interesting at Money 2020. I sat in on a keynote with Ben Horowitz from Andreessen Horowitz, a prominent VC firm. And he sort of made the point that he believes that fintech is currently in wartime. And just like presidents, the industry has a different set of priorities during wartime. And it kind of lines up with how I've been thinking about the shift that's occurred in fintechs over the past 18 months, up until mid 2022. The mentality of fintech vendors and probably a lot of tech companies for that matter was all about rapid revenue growth. If you were keeping a profit and not reinvesting that back in the business, you were doing something wrong. It was about aggressive hiring and really hiring for a future state of the business. And all of this was predicated on easy access to capital. Today, the mindset is much more so around the sustainability of the business, right? How do we get this business profitable? How do we think differently about our unit economics? Right sizing, right? Doing more with less, controlling the burn rate, and becoming more disciplined in terms of resource allocation. So it's an interesting time right now, and it kind of reminds me of this Warren Buffett quote that's been shopped around: "When the tide goes out, you see who's swimming naked." I think that's exactly the case in fintech right now, as access to cheap capital is no longer. You're starting to see who actually has product market fit and who's just kind of faking it, right? Who's still sort of searching for a direction.
Well, we see that across tech broadly too, right? This is as there is funding pullback, as there's a little more caution in terms of how things are moving forward. The funding perspective, it really does get back to business basics, making sure that you've actually got a real product, a real cohort of customers, somebody who actually is really going to, give you business and create some revenue down the road so you can actually make some money and maybe actually thinking about turning a profit someday.
That's right. And I think, staying focused right now is so critical. The current environment that we're in requires a tremendous amount of discipline. Fintech companies, again, tech companies more broadly, don't necessarily have the luxury of exploring new markets or new product categories without a well-defined plan. They need to be very intentional in terms of where they're allocating capital, because if they don't have that strategy in place, they run the risk of getting distracted, burning up resources they don't have. So I think focus is really the name of the game in fintech right now, and probably will be, for the foreseeable future.
It's taking the business you've got, making sure you hone it, make it efficient. Well, and particularly now that we're in a world in which capital actually costs money on the operations side. So I could imagine for things like buy now, pay later, a lot of those businesses, you've actually got to be reworking some of those economics as interest rates crop up.
That's right. Any business that is centered around lending right now has gotten fairly banged up over the past 18 months. And you pointed out BNPL, that's a perfect example where it's a segment that is, or at least traditionally has been entirely reliant on low interest rates. It's a segment that is reliant on consumers purchasing lots of things, ideally expensive things. And when you have economic headwinds coming into the picture, it's putting pressure on really both sides of that business, both in terms of their margins as well as the overall volume that they're seeing from consumer transactions.
And I could imagine in terms of where that goes. Are there other aspects that we should be looking out for that were coming out of the conference?
As I think about what's coming up for next year, my thesis, again, seeing what I saw at Money 2020 and just the conversations I've been having, is that fintech is starting to get boring in a good way. If we think about, where fintech is,
well, actually, Melanie Posey was on and has a great quote, and unfortunately, I can't remember the author, but that technology actually starts to do real work once it gets boring.
That is a perfect description of where we're headed in fintech, and not to discount, what we've seen over the past 10, 20 years in fintech. There's been incredible advancements, right? And a lot of that focus up until recent times was really around solving for the user experience of financial services, creating access more broadly to financial services, all very large and important problems in their own right. But what we're seeing now more of is a focus on the infrastructure and solving some of those less sexy but equally important challenges, things like treasury management, things like core banking software, compliance and governance, right? All incredibly large opportunities that once we solve for them, start to unlock net new opportunities for innovation down the road. So my hypothesis for the next few years is really a laser focus on infrastructure and modernization across financial services, again, broadly. And that's a great opportunity for fintechs that have a story to tell around helping a bank, an enterprise, an insurance company revamp any sort of process across their organization.
Well, it seems like in so many cases, we're now moving to situations in which, whatever that relationship is that an enterprise has with its customers, they want to own more of what that looks like. I think you'd identified earlier episodes, this idea that we want to be able to integrate and own more of those capabilities to be able to ensure that you can actually manage that customer experience and manage it in ways that make sense. It's something that Cheryl Kingstone's also brought up. And now we're to a point at which the maturing of those technologies, the fact that they're getting something to a point at which they can actually be depended upon, integrated into that customer interaction. When they get boring enough, now they can be something that are sturdy and solid enough to be able to build into a lot of that relationship without raising concerns about risk of customer experience and what actually transpires in terms of what that relationship looks like. If we can actually make that something that is, for enterprises, is something that is an obvious choice to be able to manage more of that interaction with their end consumers, that's all to the benefit in terms of what they're able to accomplish.
That's right. And we see that coming to life in a big way right now with vertical SaaS companies, which I know we've talked about before, but it's just such an incredible evolution where you see a provider that's selling software into health and wellness businesses or restaurants, or you name the vertical. And they're at a point where, as you say, they want to own more of that customer interaction. Well, financial services is a great opportunity to increase product engagement, to increase the stickiness of that offering, to drive a net new revenue stream. And so we've seen all of these fintechs, infrastructure-oriented fintechs emerge in recent years to sell in the underlying infrastructure and capabilities for that vertical SaaS platform to then offer a payment processing service to its small business customers, perhaps working capital, perhaps a business banking account. So that's one of the things that excites me about where fintech is going, as all of these different companies and verticals that we never would have associated with financial services start to think about the future, they begin to look a lot more like fintech companies themselves, and they need partners, they need infrastructure-oriented partners to bring those propositions to life. So, that's another kind of element that ties into this hypothesis that fintech is getting boring, and that's a good thing, right? Because we're focusing on the infrastructure and the new opportunities that infrastructure creates.
Well, it starts moving that conversation to a realm in which if some level of financing or part of that transaction is something that depends upon requiring additional funding, being able to set up accounts, being able to set up a line of credit or something to be able to actually be the partner who's selling the product, being able to get set up partner ecosystems, those sorts of things. That's something where if as an enterprise, you can offer that in places where you can integrate it, as opposed to others in which you've got to send out your partners. So it's like, well, get a line of credit so you can actually go buy stuff from me. To be able to establish that opens a whole new set of possibilities and some competitive advantages to be able to offer what is a much more comprehensive relationship to that big selling ecosystem that you're trying to build.
And it creates a great flywheel effect where if you're a business that's offering, let's say, working capital to your end customers, you're investing in your customers' growth. And as your customers become more successful, ideally, they become larger, they generate more transaction volume. And that in turn, for you as a provider, right, serves to elevate your revenue streams and your future growth. So that's what's so exciting about layering on financial services. It can really, as I say, create this flywheel that creates so many different types of advantages in terms of customer retention, revenue growth, product stickiness, et cetera.
The challenge, of course, is managing the risk, ensuring that the services themselves are going to be capably integrated into your offering. But it sounds like a level of sophistication that's grown in the fintech world that we're starting to get to a point where those options are a lot easier than they've been historically.
Absolutely. And you raise a good point about regulation. Again, another takeaway from Money 2020, there was a very large presence from regulators. You name the acronym, right? The SEC, the FDIC, the OCC, they were all there. They were in many cases keynoting panels and really sort of pushing this mentality that compliance isn't something that you just sort of bolt on at the end. It really has to be baked in from the start. And that is a stumbling block for many fintechs. So as we think about next year, this concept of RegTech, regulation technology, is really coming to the fore. Fintechs that are providing capabilities like KYC and AML and so forth have a great role to play in really helping the industry level up its commitment to risk, compliance, governance, so we can ensure the sustainability of the opportunity long term.
So do you think that's something that continues as its own separate thing? I mean, you were mentioning KYC, know your customer.
Mm-hmm.
All of this anti-money laundering requirements and regulatory compliance. It seems like there's that point at which maybe that gets integrated into the fintech company itself. Maybe that becomes its own separate sphere. What's your thought?
I think currently what we're seeing is that it's become its own separate sphere where we're now seeing dozens, if not hundreds, of vendors dedicated towards this broad category we refer to as RegTech, which can include anything from KYC and AML protections to fraud prevention to digital identity. These vendors are in many cases selling into fintech companies or selling into financial institutions to help them modernize their processes around compliance. So this is a fast-growing segment and certainly one to keep an eye on. But to your point, we are seeing some of the more sophisticated fintechs that maybe didn't grow up in this, kind of compliance RegTech realm, having the in-house expertise, having the data to build out some of their own capabilities. So it's a bit of both, but evolving into a proper category to be sure.
Interesting. Well, we'll have to see where this goes over time.
Indeed.
But this has been great and glad to have you back, Jordan.
Same here, Eric. It's a pleasure.
But we are at time, and that is it for this episode of Next in Tech. I want to thank our audience for staying with us and thank our production team, including Carolyn Wright and Caitlin Buckley on the marketing and events teams, and our agency partner, the 199. I hope you'll join us for our next episode, where we'll be talking about an adjacent discussion around this consumer experience and the shopping extravaganza as we head towards the end of the year. I hope you'll join us then, because there is always something next in tech.